Now, to help us focus on the fundamentals behind the technicals, we have George Milling-Stanley this morning, Chief Gold Strategist at State Street Global Advisors. Joining us, George, good to have you with us. Welcome. I see, well, I should say congrats and is in order as well with the Spider, the 5-year birthday, right? Talk to us about what's going on here and how the developments here. What is it? It's now, as I look, the Spider Gold Mini Shares Trust in its 5th anniversary, now with over $6 billion in assets. Spider's Gold Mini Shares Trust marks, again, this 5th year anniversary. Can you talk to us about that?
Yeah, sure. We launched GLD in partnership with the World Gold Council in 2004. That was very, very well received. It's about a $60 billion fund today. But a few years ago, we became aware that there was a general trend across the whole universe of ETFs, not just gold ETFs, the whole universe of ETFs, toward lower share prices, lower expense ratios. I think that was partly the increased focus on fiduciary responsibility. A number of people launched very, very small gold ETFs with very, very low expense ratios in competition with GLD. We wanted to offer investors a product in the Spider family. We wanted to be the leader in the low cost space, as well as being the leader in the high liquidity space, which is what GLD is. So we launched GLD mini shares with the view to becoming the leader in the low cost space. With an expense ratio of 10 basis points, I think GLDM has certainly done that. It's far and away the largest of the low-cost gold ETFs. What surprised us, I think, was that within the short 5 years of its life, it has very quickly established itself as the 3rd largest ETF of all gold ETFs in the United States. And I think that's been very, very important. It's been very, very well received. It does basically a somewhat different job from what GLD does. GLD is there for people who want to be able to trade their gold exposure. They want to move in tactically as well as having a long-term strategic allocation. GLDM is designed for people who want a long-term strategic allocation, don't need to rebalance it, don't want to make use of the low trading costs that GLD's greater liquidity gives it. So that it's horses for courses. It really depends on what you want to do with your gold exposure, Ben.
George, I noticed an interesting trend in the notes you provided. It looks like more millennials than Gen Xers and baby boomers agree that gold ETFs are now the best way to invest in gold. It looks like 69% versus 35 and 55% respectively.
Yep. That took me somewhat by surprise. I guess, all my life I've basically felt that my generation, which is, I'm a very early boomer. I'm almost 76 years old, Ben. I think I've always felt that my generation and people older than me were really the ones that understood gold. I'm fascinated to see, according to this survey, and it was a very comprehensive net that we cast here, that millennials seem to have taken over the torch from the increasingly aging boomers. I'm delighted to see that. I think basically that augurs well for gold's future as an investment. I was fascinated. That survey basically that almost 90% of respondents said that they believe that gold is a good long-term strategic investment. More than 2/3 believe that gold does well in an economic downturn. Again, 2/3 believe it's a good diversifier, and similarly, 2/3 believe it's a very good hedge against inflation. So the message is getting out there, Ben. No question about that. The one thing that did surprise me, less than half of respondents believe that they actually understand the drivers of the gold price. So I think I still have plenty of work to do in my educational process, trying to educate investors as to what really moves gold.
George, you've been on the show quite a bit, and we've spoken frequently about this chart here. If we could just pull this to your point here, gold over the long haul, a very well-defined trend up here. You can see how it's performed well over the longer term here and rewarded the bulls here. A very good example of a tool to diversify. You can see gold holding up near all-time highs, just shy of 2,100 in the retest we just looked at. But George, speaking more specifically to some of the price activity as of recent, the move lower in gold this week, it seems to be a market coming to grips with the Powell narrative finally.
I'm not sure exactly what markets are doing right now. I think that the stock market, the labor market, and possibly even the gold market are behaving as if we still had free money. We've had free money for a decade, up until starting just a year ago when Jerome Powell started to raise rates. Money now costs money, but the markets, I think, are still behaving as if that weren't the case. That's why equities are so high and why I think gold is somewhat under pressure. Is the market still living in the past, that decade of free money, or is the market anticipating that Jerome Powell is going to pivot and cut rates before the end of the year? I think Mr. Powell's made it very, very plain, abundantly plain, that he's not going to cut rates. In fact, he's going to raise rates at least one more time and possibly twice more this year, and then he's going to be driven by the data. But he certainly doesn't seem to be in the mood to pivot and cut rates. But the markets, I think, are behaving as if he will. When the markets finally believe Mr. Powell, when he says, I'm going to raise interest rates higher than anybody believes, and I'm going to keep them high for longer than anybody believes, when the markets finally start to believe him, then I think we'll see some softness creeping into the equity market, and I think that we'll see gold coming back into its own. But for the time being, we have to live with the gold price we've got.
Yeah, and it does seem the data that we saw this week seemed to kind of solidify those expectations in terms of further hikes ultimately. And that drove the U.S. dollar back to that 103.50 level, a new 7-month low for the yen against the U.S. dollar, and rates on the rise, bringing back some of that demand for the greenback, ultimately weighing on gold as well, it seemed.
Yeah, I think there's another thing coming into play, Ben, that maybe is worth mentioning. A lot of the speculative interests in gold, the hedge fund people in particular, they expect a lull in gold prices in the summertime because they got used to that a few years ago when gold jewelry was 80% of total demand. But with the increase in investment ever since we started gold ETFs 18 years ago, what we now have is that gold jewelry is only about half of total demand. So it's nowhere near as important in the greater scheme of things and in that balance between demand and supply. But nevertheless, there are still people who believe that what you do with gold, you sell in May and go away, just as people used to talk about the stock market. I don't think that applies anymore, but I think there's an awful lot of people out there who still believe there will be a summer lull, so they sell, the gold price comes down, and they congratulate themselves that they were right. But in fact, it's their own activity that drove the gold price down, not anything intrinsic to the market. Interesting
to hear about some of those changes in the trends, because it kind of ties back into what we were talking about in terms of the boomers and the older generation, kind of in theory, the associations with gold. Let's talk, lastly, if we could, about Russia. A major development. It seemed to be kind of squashed quite rapidly, but really just more focusing on the headline risk associated with gold. Also, how it's directly tied into some of, for example, speaking of headlines, the data due out at the bottom of the hour.
Yeah, look, gold has many, many different things drive the gold price. And I think that the uncertainties that we have on the macroeconomic front with, are we going into a recession? Are we not? Are we going into a recession? But with sticky core inflation, as you and Kevin were discussing earlier on the program, and also the geopolitical uncertainties. We have this prolonged war now in Europe with the potential to go nuclear. And then all of a sudden we got this new item on the agenda, which is Russia going to go into a civil war? It looks for the time being as if that tendency has been suppressed, but it took the world by surprise, certainly took me by surprise, and I'm sure you as well, that Mr. Putin maybe isn't quite as strong as an awful lot of people had thought he was. What's going to happen in Russia? I don't know. It's still a mystery wrapped in an enigma, as Winston Churchill once said. But it is all part of that background of uncertainty that typically is favorable for gold prices. The immediate response, I think, was that people moved to the dollar as a safe haven, but typically what happens is gold isn't far behind. So I'm looking for a recovery in the price pretty soon now.
George, appreciate you joining us, sharing your Friday morning part of it with us here on the TD Ameritrade Network. George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors.